Earnings seasonality, management earnings forecasts, and stock returns in China's A-share markets, co-authored by Danling Zhang, Han Song, and Hongchen Zhu. In this paper, we study the role of management earnings forecast on stock market seasonalities induced by earnings seasonality in China. Earnings seasonality refers to the predictable variation in the firm's earnings across different times of the year. For example, ice cream sell better in summers and ski gears are more popular in winters. Therefore, earnings have the cyclical nature derived from a firm's underlying business. As earnings seasonality is predictable in the efficient market, we do not expect earnings seasonality to help forecast future stock returns. Interestingly, previous research finds that earnings seasonalities often surprise the market, causing stock return seasonality. In the US, Chang and his co-authors show that firms in their high earnings quarters tend to earn higher returns surrounding earnings announcements than firms in their low earnings quarters. In China, such seasonality also exists, but the return pattern is opposite. A previous paper of mine with my co-authors showed that firms in their high earnings quarters have lower announcement returns than their counterparts. Both evidence is interpreted by investor expectational errors caused by the representativeness bias. In the US, investors appear to over-extrapolate the recent quarterly earnings, so they underreact to seasonality in earnings. While in China, investors focus too much on past seasonal earnings, so they overreact to earnings seasonality. In this paper, we study the interplay between management earnings forecast and earnings-induced stock market seasonality. Management forecast was initiated in 1998 in China. Firms that expect an over 50% change in earnings, the earnings loss, or reversed losses are required to disclose management forecast. Firms that do not meet the mandatory disclosure criteria can also voluntarily disclose management forecast. A large volume of research generally finds that management forecasts are beneficial for shareholders in terms of improving transparency and reducing risks. Specifically, we asked the question whether management forecasts help alleviate the earnings-induced stock market seasonalities. We first document the cross-sectional seasonality in returns, volume, and volatility surrounding management forecast and earnings announcements. Then we study how attributes of management forecast influence the seasonalities during subsequent earnings announcements. We lastly demonstrate how management forecasts help identify firms with smaller investor expectational errors. Our research contributes broadly to three strands of literatures. First, we add to the literatures on forecasting stock market reactions to predictable corporate events. Second, we document new cross-sectional return seasonality. Third, our evidence is best explained by behavior heuristics, adding to the market anomalies literature and supporting behavior finance theory. Our sample period is from 2010 to 2020. We start with all listed A-share stocks on major exchanges and follow the usual screening criteria. And what's more, we require a firm to have at least 20 consecutive quarters of earnings in order to calculate our earnings seasonality measure. Earnings seasonality is measured by earnings seasonal rank, earn rank. We measure earnings by quarterly net profits, which has the highest data coverage. For each fiscal year, we use the prior 5 fiscal years' quarterly data to calculate earn rank. Net profits over the 20 historical quarters are first ranked from the lowest to the highest. Then we calculate the average ranking for each of the 4 fiscal quarters as earn rank. The highest earn rank quarter is the typical high earning season of the firm, while the lowest one represents the low earning season. Another key independent variable is MEF, which is the dummy variable if a firm disclosed the earnings forecast before the earnings announcement. We also constructed several indicators for various types of management forecast: voluntary versus mandatory disclosure, and among mandatory disclosure with bad news disclosed. We measure the timeliness of management forecast by INR, the time interval between a forecast and announcement. So a smaller INR indicates a more timely forecast. We also measure the absolute profit gap between earnings announcement and management lower bound forecast to assess the information content of the management forecast. Our key dependent variables include CAR, the event window cumulative abnormal returns; TOV, the event window share turnover relative to the mean turnover prior to the event; STDEV, the event window daily return volatility; SUE, the standardized unexpected earnings. Lastly, we also study monthly return MRUT during the earnings announcement month. We first present the test of stock market seasonality during management forecast. To replicate and extend prior findings, we also look at the seasonality effect surrounding earnings announcements. We first conduct simple sorts of event CARs based on earnings seasonal rank, earn rank. Here we see when earnings rank increases, CAR decreases monotonically during both management forecast and earnings announcement periods. The Group 1 minus Group A CAR differentials are about 2% during management forecast and 3% during earnings announcements. These findings show predictable cross-sectional announcement returns that is inversely related to earnings seasonality. And we are the first to show that earnings-induced return seasonality exists surrounding management forecast. Our interpretation is that investors in China are subject to the representativeness heuristic. They tend to over-extrapolate seasonal earnings to form expectation. Expectation is too high for high seasons and too low for low seasons. Management forecast would force the correction of the expectational errors, leading to predictable stock return seasonality in the cross-section. This is similar to the effect of earnings announcement. Moving to volume and volatility, we also see when earnings rank increases, share turnover and return volatility decrease monotonically for both event windows. In other words, earnings seasonality can also help predict trading volume and price volatility during management forecast and earnings announcements. The prior papers on earnings seasonality have not studied trading volume or price volatility, so we are also the first to document the volume and volatility seasonalities associated with earnings seasonality. In addition to using univariate sorts, we also test the seasonality effects using panel regressions. Here, our dependent variables are again the event CARs. We control for a host of firm characteristics that are known to predict future returns. We further control the industry fixed effects and the year-quarter fixed effects and cluster standard errors by firms. With all controls, we continue to observe a negative and significant relationship between earnings rank and the CARs for both events. Moving from firms in high to low earnings season, from Group A to Group 1, the average earnings rank variable decreases by about 10. The estimates then imply that the corresponding CAR on average increases by 2/3%. This is smaller than the univariate estimate, but is still sizable and significant. Turning to share turnover and return volatility, we continue to find a significant negative effect of earnings seasonality. Firms in low earnings season have higher trading volume and price volatility than firms in high earnings season with all the controls. Our interpretation is that better than expected news for low season firms promotes more trading by retail investors and therefore high price volatility. For high season firms, however, the news tends to be worse than expected, but due to short sale constraints and the disposition effect, retail investors don't trade as much, leading to low volume and volatility. So our first set of tests establishes the stock market seasonality effect surrounding management forecast and earnings announcements. Our second set of tests is to address how earnings forecast disclosure impacts the seasonality effects in subsequent earnings announcements. We introduced the action term between earnings seasonal rank and the dummy for earnings management forecast to our panel regressions. Here we focus on the return, volume, and volatility effect in subsequent earnings announcements. We find the interaction term is positive and significant across the board, while the earnings rank main effect remains negative. These findings imply that having management forecast disclosure significantly reduces the seasonality effect during earnings announcements. This is as we expected. Management forecasts help to correct earnings seasonality mispricing prior to announcements, as on average, management discloses information that reviews the more rationally expected earnings. Another way to show the reduction of earnings announcement return seasonality is to use calendar time portfolios. Here we form a hedge portfolio that is long the low season firms and short the high season firms during the earnings announcement months. We see that the long-short portfolio based on firms with management forecast, the blue bars, have lower average monthly returns and alphas than a light portfolio but based on firms without management forecast, which are the yellow bars. The reduction of alphas suggests management forecast alleviate return seasonality induced by earnings seasonality. For more timely management forecast, the alleviation effect is also stronger. All of the estimated alphas are statistically significant at the 10% level or better, although the economic impact is substantially smaller than before we control for factor risks. Now we further analyze the impact of different types of management forecast and timeliness of such forecast using panel regressions. In terms of the types of management forecast, we find voluntary management forecasts have a significant effect in reducing earnings-induced return seasonality. This is consistent with the notion that voluntary disclosure contains more rationally expected earnings information. However, when firms are mandated to disclose management forecasts, we find the opposite effect. Mandatory disclosure amplifies return seasonality effect during earnings announcements. This is especially true when mandatory disclosed is bad news and when the forecast earnings is very off relative to subsequent realized earnings. These findings suggested mandatory disclosure of management forecasts do not really reflect the true earnings and do not help to reduce return seasonality effect. Let's turn to the timeliness of management forecast. INR measures the time interval between forecast and announcements, so a smaller INR indicates more timely disclosure. Indeed, our estimates shows a negative interaction effect between earnings rank and INR. This evidence suggests that a more timely disclosure, smaller INR, helps to reduce the return seasonality effect during earnings announcements. So taken together, voluntary and timely management forecasts help to alleviate return seasonality effects. Lastly, we study how management forecasts interplay with earnings expectational errors. In China, as analysts do not usually provide quarterly earnings forecasts, we rely on quarterly earnings of the same quarter in the prior year to measure investor expectation. We then study whether management forecasts help identify places with less expectational errors. By replacing the dependent variable with SUE, unexpected earnings, we find evidence consistent with our expectations. First, we confirm that earnings seasonality induces expectational errors. High seasons associated with lower SUE were too optimistic of expectations, and vice versa for low seasons. Further, firms with management forecasts, especially timely ones, have lower earnings expectational errors. This helps explain why these firms have weaker return seasonality during earnings announcements. In summary, we are among the first to document the cross-sectional return seasonality effects surrounding management forecast. We also find novel evidence of earnings-induced volume and volatility seasonalities. Firms in high seasons are predicted to have lower returns, volume, and volatility than firms in low seasons due to investor expectational errors. However, voluntary and more timely management earnings forecasts appear to correct mispricing partially, leading to alleviated seasonality effects in subsequent earnings announcements. Thank you for listening. Feel free to send your comments to my email. Bye.